My name is Philip Blackerby with Blackerby Associates, and I wanted to welcome you to this first workshop on access to financial services for small and disadvantaged businesses. I'm really glad you all were here today. So the first thing is to talk about reasons to finance. So there are several good reasons why you may need to borrow money. One is working capital. So I'm sure you've all seen this. You've got a contract. You have to go spend some money in order to fulfill that contract, but you don't get paid until after the contract is completed. Or maybe you get some progress payments, but they're always a big lag. So that difference between the money you've got to spend to do the work and when you get paid, that's called working capital. And every business has to have some of it. Now, typically, in classical business school jargon, that working capital is provided by investment. That is the investment that the company makes, that the founders make in the company when they put it together. Or it's also in what they call retained earnings. It's money that is retained in the company from previous profits, and that provides that working capital. But if you're particularly a growing firm, a fast-growing firm, that's probably not going to be enough, and so you need some additional working capital. Now, a related concept is cash flow. And cash flow is typically seasonal improvements. So we don't really have in the construction industry in this area, we don't really have a lot of seasonal issues because we can work pretty much year-round. But in some states where it's really cold, they may not be able to work during the wintertime. There are all kinds of other businesses that have seasonal cash flow problems as well, but it's kind of related to working capital. Then there are business expansion opportunities. This is what we call leverage. So you need to borrow money in order to expand the business, buy a new piece of equipment, tap a new market, create a new product, get more locations, whatever the opportunity is. If you can expand your business and generate more revenue without necessarily expanding your administrative overhead, then that's a good thing, right? So that requires some investment, though, to make that happen, and that investment is often provided by borrowed funds, and we'll talk about opportunities to do that. Real estate is the other thing. If your business requires real estate, a construction yard or whatever, real estate's pretty cheap now relative to most how everything's going. Financing's pretty cheap for real estate, so this may be a good opportunity for the business to pick up some real estate. Or for capital outlay, and we're talking about usually major capital outlay, like a big new backhoe or a big dump truck or whatever your business is, you may need to borrow money to buy that big piece of equipment. So those are good reasons to finance. Now, what's not a good reason to finance is, oh my God, I've run out of money. My business is slow. And I don't know how I'm going to make payroll next week. And, well, that's not a good reason to borrow money. That's a good reason to downsize your business if your overhead is more than you're generating in revenue. So we want to use financing as an opportunity to leverage the market and to grow our business, not just to help make it survive. Types of financing, line of credit. Line of credit is really for working capital, for cash flow management kind of purposes. Typically, you get a line of credit with a maximum. You write a check, and if the check bounces, the line of credit will cover it. You have to pay interest on that line of credit every month, but you don't necessarily have to pay principal. Now, most of the times, the banks want you to pay that principal down at least once a year, down to zero. Okay, so the idea is that it's about covering the fluctuations, the sort of natural fluctuations in your revenue stream. But line of credit is not really good for long-term financing. It's a little bit more expensive typically than other kinds of loans. There are government guaranteed loans. We're going to talk about those government guaranteed loans. They are not government loans. They are typically bank loans, or there are some other kinds of lenders. But they are guaranteed by the government, and there are several government agencies that provide those guarantees. Conventional bank loans. So you just go to the bank and you borrow some money. there are some trade-offs between the government guaranteed loans and the bank loans. Some are a little more expensive, a little higher interest rate, a little higher fees, and you got to kind of balance those off, and usually a good lender will help you navigate that difference. Accounts receivable, so this is where I've sent an invoice to a contractor, but he's probably not going to invoice the project owner like ADOT until the end of the month. So he invoices ADOT maybe a week later. Then ADOT's going to take 2 weeks, maybe 3 weeks, maybe a little longer sometimes. Okay, and so eventually ADOT will pay the prime contractor and the prime contractor will pay you. Finally. So, you may not want to wait for that money, right? And so we have a couple of factors here today, and those factors will loan you money against that invoice. They'll talk to the prime contractor and say, when you get paid, you pay the factor directly, so the money doesn't go back to the borrower, it goes directly to the lender, and they get paid off. Now, they don't give you all the money that is coming in on your invoice. They're going to discount that 1% or 2 or 3, whatever it is, depending on how long that period is. Then there are equipment and vehicle leases. You don't necessarily need to buy capital equipment. You can lease it, just like you can lease a car instead of buying it. Typically, when you lease it, it has smaller monthly payments, and that can be a good thing. But of course, you don't build any equity. You don't actually acquire ownership of that vehicle or that piece of equipment. You're just leasing it. When the lease is over, sometimes they'll let you buy it at that point, and it may be at a lower value because of depreciation, so that could be a good way to do it, but you still wind up making those payments. I leased a car one time, and then after I leased the car for 3 years, then I had to make a 5-year loan to buy the car, and so it wound up taking me 8 years before I actually acquired it, instead of if I'd have bought it up front, I might have had it in 4 or 5 years, so who knows. And then there's joint checks, and joint checks is typically when you have a material supplier involved. So you need to, you've got a contract, you're ready to go, but you have to go buy a whole bunch of materials to make that happen. And you don't have the money to buy the materials. Well, sometimes you can talk the material supplier into saying, look, why don't you advance me the materials, and then we'll make sure that when the prime contractor writes me a check, that he not just writes it to me, he writes it to the subcontractor and the material supplier together. They both then have to endorse it in order for the check to be cashed. And so the supplier can ensure that he's going to get paid when the contractor gets paid, because neither one of them are going to get paid unless both of them endorse that check. So that's joint checks. We can talk some more about that. Now, a word about banks. I hear some people say, geez, I wish that bank would just take a little risk on me. Well, banks don't do risk, okay? They just don't do it. That's not why they're in business. Banks are in business to make money on the interest on the loan, and they want to make sure they get paid the principal and the interest. Don't do risk. Now, they have set up a structure, 3-layer structure typically, to get paid back that principal and interest. Number one, they only loan money when you have a sound business purpose for borrowing the money. Okay, what's a sound business purpose? Well, it's not to survive. The sound business purpose is to enhance your business, to expand it, to buy capital equipment, to leverage it, to cover your cash flow. Well, those are good, sound business purposes. Then they want collateral. Collateral is something they can seize and sell to cover the principal of the loan in case your sound business practice didn't turn out the way everybody hoped. And third is the personal guarantee. So they'll always ask you for a personal guarantee these days. The days of borrowing money without a personal guarantee, for small businesses at least, has been over for at least a couple of decades. So there's always going to be a personal guarantee. And that means that if the business is not succeeding and is not able to pay the bill, and the collateral is not sufficient to cover the cost of the loan, then they're going to come after the owners. And they may seize a bank account. Now, there's some assets that are protected, but there are a lot of assets that they can seize that are personal assets of the owner, not part of the corporation. So watch out for that. Now, if there's a government guarantee, then there's a fourth level of protection, so this partial government guarantee. So if the owner defaults on the loan, the collateral doesn't work, the personal guarantee doesn't work, then the government steps in and covers the bank for part of it, not all of it. Maybe 80%, 90%, depends on the kind of loan it is, maybe 50%. So that's what banks do. That's how they work. Now, a little bit worried about collateral because this is one of the big barriers here, and I realize that. You know, with the decline in the housing market, people can't take out second mortgages on their home to provide the collateral. I get that. Or second lien on their home because the home doesn't have enough residual value anymore to support that equity. And a lot of businesses did not invest during the recession, didn't have the revenue to invest in new equipment. So as a result, they don't really have anything. The equipment is all depreciated. It's not worth enough now to back up a collateral on a loan. And that's a problem. But collateral has to have a saleable value equal to the loan. That's, you know, they want to be able to cover the loan. Real estate loans and capital equipment loans, the real estate and the capital equipment are their own collateral. It's just like buying a mortgage on a house. When you buy a mortgage on a house, the house is the collateral against the mortgage. So similarly with other real estate and equipment, the equipment is the collateral on its own loan. An account receivable can be collateral, and whether that's a line of credit with a bank, they may have actually have a claim on your accounts receivables. Certainly with the factors that we talked about, or the accounts receivable funders, they have a claim on that receivable. If you are a business that has inventory, that inventory is an asset, that can be collateral for a loan. Now, a lender is going to put a lien on the loan if it's a piece of real estate or a piece of registered equipment or a vehicle. If it's licensed, if they can find a way to put a lien on it, they will. I know somebody that had bought a horse on a mortgage and the bank put a lien on the horse. You bet. And then, of course, there is, for those of you, anybody located within the city of Phoenix, the boundaries of the city of Phoenix? Yeah? Anybody? Okay, so if you're within the boundaries of the city of Phoenix, you can take advantage of the Expand program. And Kedrick back there in the back row is the one who runs the Expand program. Say hello, Kedrick. There you go. And they will post for you 25%, up to 25% of the collateral that you need for your loan. Okay? 25% up to $150,000. So you could effectively use that to leverage a loan of up to $600,000. So that's a really great benefit. And they've served many, many companies doing this. It really does work. A little bit more about banks. So we all know there's the big four banks, right? Bank of America, Chase. We don't have Citibank here in Arizona, but we do have Wells Fargo. Now, the big banks are very experienced. They do lots of loans. They have a machine that cranks these loans out. The paperwork is routine. It's all that kind of stuff. And that's kind of one way to go. The other way to go is with the other banks. Those are generally called community banks. Some of them may be a little larger, some may be a little smaller. That's okay. They're called community banks. And their advantage is they're close to the local market. They are in the local markets. They don't look at it globally, nationally. They're looking at your own local market. So they know what's going on here. They know what the conditions are. They know what the economy is like in the local area. They're very competitive. They know these big 800-pound gorillas are after them all the time, the Bank of Americas and the Wells Fargos and the Chases. But they do everything they can to scramble and be competitive. So don't think that because it's a smaller bank, it's going to be more expensive. Fact is, if it's a smaller bank, it may be a little cheaper. So you need to look at that. And they emphasize customer service. Since they are local, since they are so competitive, they know the importance of face-to-face communications, and you're probably going to get a more consistent relationship with a community bank. So there's trade-offs. Good big banks, smaller banks, You know, you got to balance that out. There's a third kind of business, the community advantage lenders. These are not-for-profit lenders, and their focus is on economic development. And they have access to some special pools of money, so they're not necessarily like banks, but there are some special pools of money that they can access and they can loan to you. And we have Teresa Miranda from Préstamos CDFI. Teresa, raise your hand there. And she's got a table over in the networking room, and so you can talk to her about what kind of opportunities may be available there. But like I said, it's really not so much a straight commercial thing, because there are usually economic development policy goals involved in those kinds of loans from time to time, and so we have to satisfy more than just the business purpose. We also have to think about what are the economic development issues. The biggest loan program or loan guarantee program that the government has is SBA. I'm sure everybody's heard of the Small Business Administration. So the SBA has two basic kinds of programs. There's the 7A program and the 504 program. And here we got a little bit of comparison between them. So the 7A program, that's for your working capital, for smaller loans, for general purposes. The 504 program is really just for real estate and major equipment acquisition. The 7A program is a straight bank loan with a government guarantee behind it. The 504 program requires two loans, actually. There's a bank loan that's 40% of what you need, and there is a CDC, a Community Development Corporation, that provides half of what you need. And who has to provide the other 10%? The business owner, right? So, 7A program is limited to $5 million by and large. The 504 program can be much more money involved. 7A program, typically 7 years, though we'll see that you can get a little break on the interest if it's less than 7 years. So I'd really like to write a loan that was 6 years, 364 days, right, to get that break. It could be 10 years. If it's an equipment loan, then you have to look at the useful life of the equipment, and you can't have a loan that's longer than the useful life of the equipment. So think about how that works. I'm not sure how long a dump truck lasts, but it's many years. But its upper limit is 10 on these loans. On the 504, you could have a 10-year program or a 20-year program. It's much more like a mortgage. So the term is tied to the purpose on the 7A program. Both programs have to be fully collateralized. So you have to have collateral equal to the value of the loan, both the 7A and the 504. But of course, on the 504 program, the real estate or equipment is its own collateral. Both will require a personal guarantee. There's a fee for the guarantee. Now, the cool thing about the 7A program, yes, you pay a fee for the guarantee, but you don't pay any other bank fees. Okay, that's kind of one of the cool things about it. With a conventional loan with a bank, you may have to pay a whole bunch of bank fees, but not the guarantee fee. So you got to kind of balance those off. And again, your banker should be able to help you figure out what's the better option. The key things are, what is the cash flow of the business? Is the business going to be able to support paying off this loan principal and interest on both of them? What are the business assets? Particularly, what are those assets that are going to provide the collateral for this loan? That's the other thing. And the third thing is the FICO score. What is the credit score of the owners of the business, the principal owners of the business? A principal owner is somebody who has 20% interest or more. So look at those FICO scores. We'll talk some more about FICO scores later. Just want to cover some other government guarantees. The U.S. DOT has a short-term lending program. It's a line of credit. It's a special thing. You've got to be either a Section 8 DBE. So a Section 8 is women or minority-owned business, small business. So going through the federal certification for Section 8 is kind of like going through the state certification for DBE. So it's a pretty rigorous process, but I would encourage you to go through that process if you qualify for it. They really emphasize hub zone. Hub zone is sort of low-income areas, and so if you're located in a hub zone, then that's a real big plus. And they're particularly interested in service-disabled veterans. So if an owner is a service-disabled veteran, that can really help get that short-term loan. But this is really a line of credit. Up to $750,000, this is just short-term money that you can get through DOT. The USDA, that's the Department of Agriculture, believe it or not, has business and industrial loans. You wouldn't necessarily think that, but if you're in Payson maybe, or Prescott, or kind of those sorts of areas, that works. It has to be 50,000 or fewer population and not attached to a metropolitan area. So where I live, Fountain Hills is attached to a metropolitan area, so it doesn't qualify even though it's less than 50,000. But Payson is not adjacent to a metropolitan area, and it's less than 50,000. So real estate, machinery, working capital to 10 million. There are loan-to-value ceilings, so if the equipment that you're trying to buy, then you can only borrow 80% of the value of the equipment, so that requires a 20% down payment. And depending on what it is, there are different kind of loan-to-value ceilings. There's a 60% to an 80% guarantee, 2% fee, and then a little 0.25% renewal fee every year. The third one is the Bureau of Indian Affairs. Has a loan guarantee for businesses that are 51% owned by Native Americans. So if you qualify for that, there's all kinds of really nice money available through the BIA guarantee program. There is, a lot of paperwork to put together an SBA loan. And this is a list of it all. And, it could be, a small binder full of paper. So there's a lot involved, and it sometimes seems kind of daunting. But don't despair, because there's help available. So there are at least 4 organizations around the state that are available to help people put together loan packages, consultants like myself who are available to help do that. And depending on what the program is and what your qualifications are and all of that, it could be free to you. Doesn't necessarily cost you to get some help putting this together. So first of all is the ADOT Business Engagement and Compliance Office. That's Kent Lane. So if you need some help, talk to Kent. He'll get somebody like me, or there's several of us around here, and assign you to help work out the paperwork. City of Phoenix has the Management Technical Assistance, the MTA program. Kedrick is also running that program, and they have consultants available to help you put together this paperwork. Small business development centers are all over the state. They're everywhere. And the small business development centers will help you do that. And they're affiliated usually with the SCORE program, used to be called Retired Executives, whatever it is. And SCORE programs, and they can also help you put together this paperwork. And then in Tucson, there's the Micro Business Advancement Center. So there really are places all over that you can get help. And all of this is covered in the handbook. So